All right, welcome back to another edition, another chat of Portfolio Talks. And today we're joined by Ian Hardacre and John Fisher from Bridgeport Asset Management, one of our preferred partners. And they're really our asset management uh, division of our practice. And they help our clients manage and properly allocate their life savings because it's only your life savings. So we want to make sure we have somebody with a hand on the wheel. John, Ian, thank you so much for joining us today for the mid-year check-in.
Thanks for having us.
Hi, Tyson. Yeah, thanks for having us.
Yeah, awesome. So one of the things that we wanted to do is kind of check in middle of the year, quarter two performance should be done, and kind of talk about some of the highlights of what you guys saw the beginning of the year, because there was certainly a lot of headlines and a lot of turbulence with tariffs and things going on south of the border that are influencing markets and influencing us. And so maybe, I don't know, Ian, if you wanted to maybe go first and talk a little bit about what we
Sure.
were seeing in the headlines versus like what was actually happening.
Yeah, sure, Tyson. I thought I'd start just talk a little bit about the investment style. I like to talk about it each time we're talking about Bridgeport. Just briefly, our investment style in the public equity funds is value oriented, but not deep value, fundamental investing. I like to say growth companies at value prices is what we're looking for. There's three ways of doing that. One, take advantage of pessimism in the market. So we do our homework on companies we'd like to invest in, and we wait for pessimism in the market, dislocations in the market to hit our buy price. That's number one. Number two is an idea that's different than the market perceives. It could be a different product, it could be a different service, it could be us understanding that the potential of that product or service better than the market. And then three is just time arbitrage. Time arbitrage is really taking advantage of the market's focus on the short term, where we can take a 2, 3, 4 year view on a company and make outsized returns over that time. So just a little review on our investment style on the public equity side. We have three pure funds: large cap Canada, large cap US, and a small mid cap. And then our high income fund has about, give or take, 20 to 25% stocks in it, combined with bonds. So those are the four funds. The midterm review, I mean, I like to say right now we're sort of living in a time of managed chaos. Now that provides opportunity on the investment side. You know, if I think of four main, macro factors right now, and there's more than this, but one is the tariff discussion. That's day to day, week to week. I think the market's become somewhat immune to it, in the sense that we get announcements one day, we get very low reaction in the market. It's not like April, Liberation Day. I think what we need to focus on, what we do focus on here, is more the effect on the economy. When we look out 6, 12, 18 months, what is this? How is it going to affect the economy? Is it going to be stagflation? Is it going to be inflation? Is it going to be a recession? Not so much the day-to-day announcements, because we know they change the following week. Number two on the macro would be geopolitical, ongoing wars around the world. And for Canada, it's really the effect on the oil price. I mean, energy is 17% of the TSX, makes up 17% of the TSX. So the oil price matters to the Canadian market. Thirdly, really noise around the Fed, Jay Powell, the Trump administration. I mean, his term's up May 2026. Will they try and get rid of him sooner than that? But even if they don't, I mean, it looks like rates in the US are coming down, and how that affects the US dollar. And lastly, and I think probably the most important of all, is the increase in the debt in the US. The one big beautiful bill will increase the deficit over the next 10 years somewhere between 3 and 5 trillion. And I think that's incredibly dangerous. And I think governments around the world are just piling on debt, whether they're considered liberal type governments or conservative. Everybody's just spending more, and that's going to have a long-term effect on generations. And I think that's important. Now, for us, some of these macro events create opportunity. They create volatility in the market, which allows us to buy individual securities at discounts to what we believe they're worth. So while there's always going to be macro factors, there's always going to be that sort of issues in the market. And if you look back historically, those one-off sort of events of a lot were great buying opportunities over the majority of my career. So when I look at the end of June, All our public equity funds are positive territory, single digits. So I'm happy with that, given everything that's happened in the market, especially coming off, double-digit returns last year for the most part. So I'm happy with the way we're positioned. Individual stocks, if I talk about each of the funds, like if I first look at our U.S. fund, a good example of a stock is Uber. We purchased Uber at the end of last year, beginning of this year, when the stock pulled off because people were worried about the robo-taxi. And over the stocks since then been up about 50% because people realize robo-taxi is going to be part of the equation when it comes to Uber-like services, but they'll be involved in it as well. And they're partnering with everybody. The Canadian fund, Cameco is a good example. We bought Cameco 3 or 4 months ago. It's risen significantly. As you know, they're a seller of uranium. Nuclear is going to be one of the solutions for electricity going forward. For a number of reasons, the world needs more electricity. Nuclear is considered somewhat of a clean energy. And so globally, nuclear could be strong for the next 20 years. So we bought that when the uranium prices sold off a bit, and Cameco sold off as well. And lastly, small mid-cap fund, Northern Trust is a good example of a type of business we own. It's approximately 50% asset servicing, 50% wealth management, very high net worth, affluent families. It's up about 25% this year, and that's we've owned that stock for close to 2.5 years, and I believe it'll be a compounder over time. So that's really the review for the year. I mean, if you look at it, there's a lot of macro factors going on. We all know that. That's number one. Number two, that provides opportunity. And three, happy where the funds are positioned right now as we approach or just get past the middle of the year.
Nice. Yeah, super happy with that. I was doing some annual reviews with some clients, and the ones that I did, they've been on Bridgeport for about a year, maybe 16, 17 months. Their performance was awesome. And what I like about it is we don't have the drive to we don't need to showcase performance, but it's just chugging along in the background. And then when we actually look at what the performance was over the last year and a bit, it was fantastic. So they're super happy. They're super pumped that they made the move. And I like that we don't have to sell performance, but we sell the process. And you guys do such a great job of that. And so maybe that's a great segue to bring it over to John and talk a little bit about why we utilize the process that we do and how Bridgeport was built to bring this to the market.
Yeah, sure. I mean, our overall investment strategy really emulates a similar investment strategy that larger institutional investors use. So investors such as pension funds, university endowments, large multi-billion-dollar family investment offices. And that strategy, at its core, it's really about mixing publicly traded strategies, strategies that involve kind of using stocks and bonds, what Ian was just talking about, with many different segments of the private asset universe. And so private assets, as we talked about last time, just a bit of a recap, it's a very broad area, but it's essentially all these different assets that are not publicly traded, that are not stocks and bonds. So it includes everything, including, for example, private equity, which represents ownership interests in basically private companies, non-publicly traded companies, entrepreneurially owned companies, or kind of companies that are owned by private equity firms. So these are non-listed companies. It involves private ownership of different forms of real estate. Could be apartment buildings, could be self-storage facilities, could be retail properties. We'll even talk a little bit later. We've got some real niche real estate categories in our funds. We just purchased in the early in the year, we purchased a portfolio of kind of recreational sort of vehicle properties. So parks, which is a real, sub niche in the real estate area. It includes private infrastructure assets. So things like toll roads, ferries, IT infrastructure, energy installations, things of that nature. And it also includes private loans. It could be loans to, like could be loans against real estate, both residential as well as commercial real estate. It could be loans to kind of various types of private companies. It could be royalty streams, such as music publishing rights or pharmaceutical royalties. So it's really generating income streams or capital appreciation from all these different types of assets that don't trade every day in the stock or bond market. And so what you typically see, and why we include them in our kind of portfolios, again, to really emulate the same type of asset mix that institutional investors have, is because it really provides an enhanced level of kind of diversification, superior rates of return, while also making the overall portfolio a lot less volatile. So if you looked at our typical client portfolio in the first week of April, when Trump announced Liberation Day, and that's sort of now in the rear view mirror, but the stock market went down quite a bit. I think from top to bottom, the broader US stock market was down close to 20%, just a couple weeks. Our typical portfolio was down nowhere near that amount of money. Our equity portfolios overall kind of, ended up kind of declining a lot less than the broader markets, but our private asset portfolios held their value very well. Those investments in real estate properties, ownership interests of all the private companies didn't really move all that much. It's not to say that long term all these assets aren't affected by the same factors that Ian had sort of mentioned earlier, the tariffs and everything, but it tends to be a slower moving kind of process. There's sort of more evaluation. You don't get the huge kind of declines, and then often not the huge snapbacks. It just kind of chugs along a little bit. Things do get sort of evaluated. So we have 3 funds that most of our clients are invested in this space. One of them focuses in on just on private equity. So that's basically privately held companies. One focuses in on real estate as well as infrastructure, as we call it, real assets. And then the third is a private credit fund. So it's really income generating strategies, which is loans, leases, and royalty streams. So overall, in the last 6 months, I'd say those areas didn't suffer from the same kind of volatility that the stock market did. It's been a fairly sort of muted 6 months in the private asset world. We've seen very modest gains. I'd say the market's playing like a little bit of catch up. The overall transaction environment, so the buying and selling of these private assets, it's been a little slower in the last 12 months after a pretty heated period. We think the next 6 months, things are going to start to pick up. We've seen some assets doing really well, making nice gains, others taking modest markdowns on a net sort of flats up a little bit. But I think what we're seeing is activity starting to pick up. The real estate market has been pretty moribund the last couple of years after a 20-year bull run. Some really interesting opportunities are starting to pop up there. And, I'd say kind of despite the relative quietness of the private asset market, we've been quite busy allocating into lots of different interesting niche strategies. I won't spend a lot of time in each one, but if any of your viewers are sort of interested in this, I mean, as I said, we did partner with probably one of the largest family offices here in Canada. We partnered with their real estate arm, and we purchased 13 recreational vehicle properties in partnership with them from a U.S. publicly traded REIT that was essentially kind of retreating from its Canadian operations. And I don't know if any of your viewers have ever stayed or kind of rented a spot at an RV park, but I mean, they're nice kind of businesses. You essentially, as a park owner, you own all the land, and as kind of the landlord, you lease out the pad or the space to someone that wants to rent it for the season, typically, which here in Ontario is May to end of October, and they pay for the rent up front. It's usually $4,000 to $6,000 for the season, and they will then place their own trailer or like a park model home, a sort of inexpensive cottage on top of their spot. And so there's very low turnover year to year in the tenant base, and you get all of your rent up front before the season starts. So it's very low risk. You tend to get rental rate increases of 5 to 6% a year. There isn't any rent control because they're seasonal properties. They're not year-round properties. So in Ontario here, there is no rent control. You can raise the rents as much as the market will bear. So they're very like steady Eddie types of businesses. So that's an example for our real estate fund where we invested kind of directly with some partner firms in a portfolio of assets. In that same fund, we also allocated capital to a very large firm called Partners Group. They're out of Europe. They're one of the largest private asset managers in the world, and we allocated to their infrastructure asset fund, which has been around a long time. Also in that fund, we put money into self-storage kind of property fund with a very well-known Montreal asset manager and real estate kind of developer that's been in business there for about 50 years, managing money, sort of outside institutional capital for the last 20. And, that's a really interesting real estate segment. Many of your viewers actually, might have had experience as a consumer using self-storage when they're moving or they don't have enough space. We allocated money to private equity funds managed by Carlyle Group, which is a really large, one of the largest US private equity managers, also like a publicly traded company. And also another firm called AlpInvest. AlpInvest is owned by Carlyle. So that's kind of the Carlyle fund. Then we also allocated to a really well-performing private equity fund out of the US, which is called Dextra, which is in this sort of middle market private equity space in the US with really great kind of rates of return and a long history.
That's awesome. That sounds great. I actually just started reading the founder, David Rubenstein's book, How to Invest, right? The founder of Carlyle Group. I just picked up his book and it's on my nightstand right now.
Yeah, and he's got a show, I think, on like Bloomberg TV or where he like interviews really interesting guests, I think, from time to time.
Yeah, that's cool. So Ian got to talk a little bit about their process in selecting and pre-selecting securities. On the private side, what does the underwriting process look like? Like, what does the start to end kind of funnel look like for you guys?
Sure. I mean, I would say at a high level, what we try to do is sort of evaluate all of the subsegments within each private asset category. So there's different types of private equity, there's different types of real estate investing, different types of infrastructure asset investing. So we'll, at a high level, try to evaluate which of the subsegments we find attractive. So for example, within real estate, I just mentioned self-storage. We could find the greatest manager of self-storage real estate assets that's out there, but if we don't think it's an attractive real estate segment, we probably don't want to look at any of them because, you can find the best manager that will do the best job within that space, but it still may not meet our risk-adjusted rate of return threshold. It's possible that we just can determine, people make money in this space from time to time, but consistently it seems hard to make money. The invested capital rates of return aren't great. Like, why do we really want to be in this subsegment? But once we find a subsegment that we like, then we start to target the best-in-class managers in each of those segments, and we'll go out and meet a whole bunch of managers and try to figure out who are the best managers. So from there, what are the metrics that we look at to say, well, who are the best managers? So, I mean, one is obviously you're looking at their track record, but it's not just the track record. It's what is the length of the track record? What is the depth of it? And how have they generated those rates of return? So, for example, if you find out maybe they've done one or two funds in the past, but in each of the funds, most of the overall portfolio returns have come from 10% of the deals, that may make you a little bit skittish. Is that something that the manager can replicate? They did 20 investments in their last fund, but most of the returns came from 2 deals that were grand slams, and everything else just didn't make money or only made a small return. It gives you a bit of pause. Is that going to be something that they can do again and again when maybe only 10% of their deals are actually contributing to the overall rate of return, even if they're phenomenal deals? So that's something that'll give you pause. I mean, really look hard at the track record. The second thing is you want to obviously look hard at sort of management, the people that you're backing. I mean, that's really the number one thing. I mentioned track record first. You can have the best track record in the world, but if you're not comfortable with the team from a depth perspective, from an overall integrity perspective, from an alignment of interest perspective, are they heavily invested personally in the fund? Does everything kind of line up? Are they doing too many things? Do they have enough people on the team to execute the strategy? We often, for like a really big fund like a Carlyle Group, we won't do background checks because these are huge firms with hundreds and hundreds of people. So it's not, but if we're dealing with a smaller firm that might have a 20-person investment team or a 30-person investment team, we'll often do third-party background checks on the managers just to make sure everything's checking out. There's nothing coming up. We'll certainly talk to other investors in their past funds, pension funds, university endowments, family offices. What's your experience been like with this manager, hopefully over a number of years? We, of course, will look at the terms of the fund, the term. There's a lot of terms once you get into the limited partnership agreement. How are they earning money? Are they aligned? Are they invested with us? What are the terms around making changes to the fund? What percentage of investor approvals do they need? All sorts of things that we comb through in detail. And then also we'll look at all, the tax situation. Sometimes we come across funds where they're really interesting strategies. They're not homegrown strategies. They're not here in Canada. They're in the States. They could be in Europe. They could be offshore. And we need to make sure we understand the tax impact to our fund and our end investors here in Canada. And sometimes we do come across great strategies, but unfortunately, because of the tax situation, crossing the border, a lot of the return gets lost before it hits our fund and gets ultimately earned by our end investors. So we'll do a tax review, and sometimes we'll do that pretty early in the process because we do determine sometimes we like everything about this opportunity, but the tax is going to kill us and we just can't move forward with it. And so that's super important. And then all the administrative stuff around it. Who is doing the audit on the fund? Is it a Big Four firm? Who is their fund administrator that's striking a NAV, like a price on the fund units that our fund holds every month or every quarter? Who is legal counsel? Like all those providers around it, and are they blue chip? Are they credible? Do they have outside kind of providers doing it? All that stuff's really important. So it's a very extensive process. It doesn't happen in like a week. We're usually evaluating one of these investments over 3 to 12 months, I would say. If not longer. Sometimes we'll track funds for years before we invest.
Gotcha. That makes sense. And that's really reassuring too, that you're not jumping into anything, as there's a lot of methodology to it.
Yeah.
And so once you're in it, you've probably looked at numerous deals and said no before you've said yes to the one, right?
Yeah. And I was just going to say, it's important to just point out again, and I think we did this last time, that within each of those 3 private asset funds, we have multiple portfolios. So if one of them isn't doing so well, it's not going to be super noticeable. There's usually, give or take, about 20 individual portfolios of private assets within each of the private equity, real asset, and alternative income fund. There's usually about 20 underlying portfolios in each of those. So if one of the 20 self-storage, again, not to pick on the self-storage, but I brought it up. If the self-storage market isn't going well and there's not a lot of demand and they have less tenants, it's not going to be super noticeable because it's only one of approximately 20 portfolios in our real estate and infrastructure asset fund. And then just to drill down again, maybe one self-storage property in that fund that isn't doing well, but the fund itself has 15 properties. So you can start to see that it's not going to really show up in a super meaningful way in an end client's rate of return they see on their statement, because there's so many legs to the stool and so much in the way of diversification.
Yeah, I like that. I really like on the private side, you guys have the multi-manager strategy. We've seen a few other shops where they're the purchaser, they're the owner, the manager, they run the whole deal like soup to nuts. And you just think, man, if anything happens to their like operation, who's managing it?
And we're sort of independent. So if we see that maybe something isn't meeting our kind of return threshold, then we'll just, sort of over time, we'll just kind of like redeem out of it and allocate somewhere else. We don't have to get wedded to a certain strategy. Not everything's going to be perfect. Obviously, you're investing in a lot of things and you do your due diligence, but some things, will work out better. And over time, you rework the portfolio and make changes as you learn things and you see sort of results streaming in.
That's awesome. I'd love to transition just a little bit. I do have some questions for Ian, just on stuff that we kind of see in the marketplace, and I think he's the appropriate one to answer this. But you've seen the trend, Ian, over the last 10 years, 15 years, where talking heads and even markets are directing investors to be DIY and buy the index, and like, just if the index is doing 30%, you're getting 30%. But there's got to be a point in time where if everybody's doing it, the goodness has kind of been sucked out of it. And now, as a professional asset manager, what do you see as some of the cautions to people who are DIY investing, but maybe don't have any of the disciplines of being like their own manager?
Yeah, no, good question. I mean, I think one of the things that's been missed over the last 5 or 10 years is preservation of capital. So one of the things we focus on, first of all, is protecting people's capital, protecting their money. When markets are going straight up or have been, up almost every year, people forget about that. So active management really works in a down market. Not only does it preserve people's capital, but we also have the opportunity to add dislocated stocks. I think people have been a little bit just, some of it's media, but also if you look at the S&P 500, we have 7 stocks that dominate the index. And, for the most part over the last few years, number of years, they've gone up. At some point, history will tell you that that's not going to happen. And I'm not sure when that is. I can't tell you when that is, but I think people have been lulled into sleep that, investing in the stock market's easy, and it's not, right? So there's been points in time, and especially in my career, where we've seen markets down well in excess of 20% for somewhat of an extended period of time. And I think people have forgotten about those times with what's happened with low interest rates, et cetera, over the last number of years.
Yeah.
And I would say even to the extent we've seen those losses, we've seen recoveries pretty quickly. And I think it's a different story when the recovery takes more time. It requires more investor patience and more portfolio manager patience. It's easy to hold on through a downturn when it lasts 3 weeks. It's a little harder when it lasts 24 months. And we haven't seen a lot of that in the last little bit.
Yeah, very true. In my brain, in my caveman brain, I correlate this to like what we're seeing in the Toronto and the Vancouver real estate market, where everybody that's bought in the last 15 years thinks that they're a real estate investor because they made 30, 40%, but they've never been through hard times. Whereas when I was at the bank and I had clients that bought houses in the 80s, and they said they lived through 18% interest rates and all the other things that happened.
Exactly.
They're like, that makes a real real estate investor. So I think, the good times have lulled people a little bit to sleep. And I guess part of the normal combat that we see when we're talking to these DIY investors is their first thing that they bring up all the time is, well, my portfolio is low fee. Ian, we bring stuff to the table. So you bring alpha and beta to the portfolio, right? With our financial planning, we're supposed to bring gamma to their situation. But can you talk a little bit about like how a portfolio manager can maybe do more or do better for them over the long term? I know you kind of alluded to capital preservation, but when bringing on a portfolio manager, like what does it offload from the client?
Yeah, I mean, it offloads professional management really, and that I think for an individual client, I really firmly believe they need to do their best to understand the investment process and what type of investing they're getting and what their expectations are. Because if they're really a high risk and they want high risk and they want high growth and they're willing to take the downside, that's probably not the right type of investor for us. We're more fundamental, bottom up, compound people's capital over time. So I think a lot of it comes when you look at DIYs or individual investors is what are their expectations? What are their goals? Is that asset manager's investment style the right investment style for that person? And I think that's been a problem in the industry historically is people don't do the research on the investment manager or the expectation set is wrong.
That's a great answer. I agree. And then when we have mismet expectations, it feels like somebody did something wrong, but we just did what we were supposed to do. Expectations weren't set at the beginning properly. So I think that's a great way to frame that.
Mm.
I'm super happy with what we've experienced the first half of this year, and then definitely with my clients that have been on the platform for a little more than a year. I'm not sure what else we can have in terms of questions for you guys at this moment, but do you guys have any closing remarks, anything you want to add for maybe what we're looking for in the next year to 3 years of partnering with Bridgeport?
Yeah, I mean, on the public equity side in the stocks, it's consistency of investment style, consistency of discipline. I mentioned preservation of capital. That's super important for us. That's the number one rule in investing is protect individuals' capital and then grow it beyond that. So that's invest with a margin of safety. I mean, I think that would be the ongoing thought that I would leave with everyone.
Nice.
I think just on the private asset side and from a more sort of holistic perspective in terms of the whole portfolio, I mean, I think what you're going to get with us is a less volatile, a more consistent return portfolio than you get if you're doing it yourself or you're indexing. It's going to be less of a roller coaster ride. The mixture of, Ian's management on the equity side and our private asset portfolios really complement each other really well. But the private assets, as I said earlier, you're getting a great collection and a very sort of diversified mix of all these different types of private assets that give you lots of different sources of investment return from making money when people download songs on Spotify to when people are purchasing pharmaceuticals or earning interest income from loans against apartment buildings or ownership interests in all different types of private companies of different sizes and different industries all around the world. Like that's really kind of diversified. For all those sources of investment returns to get hit all at once, we often go through that mental exercise here, like something really fundamental and global and systemic needs to happen even beyond a global pandemic that we just went through, which affected some things significantly and other things that actually boosted them. So I think with the level of kind of diversification that you have with us, like, would be a really cataclysmic, almost historically unprecedented event that everything really, is significantly adversely impacted. Anything's possible. And obviously we all have to live in that world, but there's just so many legs to our stool here in terms of how we generate returns that we feel pretty good about, what we do every day.
Nice. I feel really good about it too. I sleep well at night knowing I don't have to be the asset manager and the portfolio creator and all of that stuff. So that's great. I'm really happy with our partnership. I want to thank you guys for doing this.
Thank you.
And I'm sure we'll do another one probably at the end of the year.
Yes.
Hopefully, we don't have as much turbulence and news headlines. But I really appreciate it. Thank you guys for jumping on today, and we'll see you guys towards the end of the year.
Yeah, thank you
Okay.
very much. Also,
Thanks,
really
Tyson.
appreciate it. Yeah, and the partnership as well. Thank you.
All right.
Take care.
Bye.
All right. Thanks, guys.